A bad company can look cheap for a very long time, and if the business keeps weakening, the stock can stay cheap or get even cheaper. So let's go step by step and break down the 5 biggest signs the stock may be a value trap. The sign number 1, revenue is shrinking. Let's start with the most obvious warning sign: the business is getting smaller. A company can have low valuation, but if revenue is falling year after year, that is not a small issue. This means demand is weakening, the business is losing share, or the product is becoming less relevant. Here's how to check it. Look at the last 5 years of revenue. Check whether revenue is growing, flat, or declining. Compare the latest year with the previous years, not just one quarter, please. A one-time drop is not always a disaster, but if revenue keeps falling, that is usually a sign of a deeper problem. Because a shrinking company deserves a lower valuation. The market is not stupid. If the sales are falling, the stock is often cheap for a reason. So there is a simple rule. If revenue is declining for several years, do not assume the stock is undervalued just because the price is low. And even if revenue looks okay, some companies still hide much bigger problem: profits that are not backed by real cash. So the sign number 2 is earnings looks good, but cash flow is weak. This is one of the biggest traps for beginners. A company can report profit on paper while the actual cash coming in is weak. That is why you should never look only at net income. You need to check operating cash flow or free cash flow at least. Here's what you look for. Is net income growing but cash flow is still falling? Is the company making account profit without real cash? Does free cash flow stay positive over time? A healthy business usually converts profit into cash. If it does not, something is off. That could mean aggressive accounting, slow customer payments, high working capital needs, or a business model that does not generate real cash. Simple rule: if profit looks strong but cash flow is weak, be careful. Cash is harder to fake than any earning. So sign number 3 is if debt is too high. Debt is not always bad. In fact, good business sometimes use debt wisely to grow. The problem is when debt becomes too large, especially if profits are unstable. A company with too much debt has less freedom. It cannot invest as easily, survive downturns as well, or make mistakes without any consequences. How to check debt properly? Look at 3 things: debt to equity ratio, interest coverage ratio, and trend in debt over time. What is good debt to equity ratio? There is no perfect number for every company because it depends on the industry, but as general idea, lower is usually safer. A very high ratio can be risky, especially for non-financial companies. The most important thing is to compare the company with its peers. Better rule than one magic number. A debt to equity ratio that looks normal in one industry may be dangerous in another. For example, capital heavy industries may carry more debt naturally, but for business with unstable earnings, even moderate debt can become a problem. Also check interest coverage. This tells you whether operating profit can cover interest payments. If a company struggles to pay interest, that is a major warning sign. Simple rule: debt is okay when the business is strong, debt is dangerous when the business is weak. But even a company with a manageable debt can still be a bad investment if the people running it are making poor decisions. So, sign number 4 is management is weak. A lot of value traps are not just bad business, they are badly run businesses. Good management does not need to be flashy, it needs to be honest, disciplined, and consistent. How to check management? Ask these simple questions. Do they explain problem clearly, or do they hide behind excuses? Do they keep missing their own targets? Do they make smart capital allocation decisions? Do they dilute shareholders often? Do they buy back stocks at the wrong time? Do they keep changing strategy every year? Good signs are clear communication, consistent execution, honest discussion of risks, sensible spending, insider buying, not just selling. Bad signs: constant promises with no results, frequent CEO or CFO turnover, sudden strategy changes, too many acquisitions, share dilutions, management blaming everyone else except themselves. Simple rule is: if management talks more than it delivers, be careful. A bad management team can destroy even a decent business over time. So now let's look at something every investor hears about: the moat. So sign number 5, no real competitive advantage. A cheap stock is not great investment if the business has no protection. The protection is called a competitive advantage or moat. A moat makes it harder for competitors to take customers, copy the product, or crush the margin. How to check for moat? Look for signs like strong brand power, pricing power, high switching costs, network effect, unique technology, high return on capital. What to watch in the numbers? Gross margin trend. If company has a great moat, usually gross margin trend is growing and it is over 10%. Operating margin trends, same. Return on equity, it should be really high. Return on invested capital should be really high as well. If the company has weak margin, no pricing power, and returns that are poor compared with the peers, then it may not have a real moat. Simple rule, if any competitor can easily replace the company, the stock may be cheap for a reason. So now let's put all of this together into one simple process you can use before buying any stock. Before buying a stock, ask these 5 questions. Is revenue growing, flat, or shrinking? Are earnings supported by real cash flow? Is the debt load reasonable for the industry? Is management honest, disciplined, and consistent? Does the business has a real moat? If the answer is no to several of these, the stock is probably not a bargain, it's probably a value trap. So we just discussed how to think like a value investor. The biggest mistake investors make is chasing cheapness. A stock can look cheap and still be terrible investment. What matters is not just price tag, what matters is whether the business is strong enough to grow value over time. A great business at fair price is usually much better than a weak business at a very cheap price. That is the mindset that protects you from value traps. So next time you see a stock that looks too cheap to ignore, slow down and run through this checklist. Check the revenue, check the cash flow, check the debt, check the management, check the moat. Because in the stock market, the cheapest looking stock is not always the best deal. Sometimes it is just the one everyone else is trying to escape. If you understand that difference, you will already be ahead of a lot of investors. If this video helped you, subscribe for more investing breakdowns, value trap lessons, and practical stock analysis to help you build a smarter portfolio.